but that divergence there was enough for me to look at this liquidity as a raid, especially if we run a short-term high, right? This short-term high right there, we run through it there, that candle. So we have technically a shift in market structure that's bullish. Now, a shift in market structure, this is for your notes. A market structure shift is just a short-term change in market sentiment, and it will deliver on a short-term basis. A market structure break is where the entire tide of the marketplace changes and we go into a longer, higher time frame delivery of price, where if it's been bullish and then we have a break in market structure that's bearish, then what we're saying is there's a change in trend, if you want to call it in retail logic. A shift in market structure is not equivalent to an outright reversal. It's just a change in short-term market sentiment. And that's all we need to capitalize on in terms of intraday price action. So when we see the short-term high changing here, right there, that candle, once it passes through it, this is for your notes also, a shift in market structure does not require a higher close above the short-term high. It just needs to trade above it. The algorithm is not basing its next run on price because it closes above that. It just needs to run through it. Once it does that, that trigger now starts a macro. A macro is a short list of instructions that the algorithm will run, and the price engine that creates these fluctuations in price. It matters not how much buying and selling pressure. That's a misnomer. It's a lie. So once we get below the sell side here, we run through this short-term high. There's a shift in market structure. Now it's bullish. So your eye goes to what? My eye goes to where's liquidity. So the first thing I want to look for as I pan back is I want to look for, is there a relative equal high, something smooth? These highs are basically almost the same, right? Retail thinks that's the highest it can go because that's what the books tell them. They say in their mind, okay, this is the highest it can go because that's resistance. It's going there and going above it because that's exactly where the money's resting. That's where the victims are holding up signs. When the market trades down to the sell side here, and then I'm watching, does it shift bullishly? There's a shift in market structure with that candle right there. It does not need to close above it. So now in my mind, I go back through what just took place. Well, we just ran sell side. We have SMT divergence. If I'm anticipating the likelihood of something bullish, I'm already expecting the SMT. I'm not using the divergence as a trade selection. It's a confirmation tool. It qualifies something that I had already anticipated. This was too smooth. We were going below sell side. We went through it. If it went through it and we didn't diverge, and if the NASDAQ made lower lows with the S&P, then I would not expect this. If the NASDAQ would have made a lower low like it did here in the S&P, I would not have gone long, even if it went above that short-term high here, because then I would have expected this fair value gap to be something to be monitoring. But because we had that divergence with the NASDAQ lows not meeting the lower low that we see in the S&P here, then I want to watch and see, does it tip its hand to me and say, Michael, this is what I'm about to do. I'm going higher. Get on board. I'm going to give you a fair value gap. It runs above the short-term high here, there. This candle's high and this candle's low. That's what I'm framing here. That's the fair value gap. So the market dips back down into this area here on the news, comes back up, and the candle closes here. The next candle opens, trades one more time. This is the only other opportunity you have. But what is it really reaching for? Look at this wick from the low of the body, which is the closing price, to that low. Eyeball half of it, and it's also inside the fair value gap. Then it rips through this short-term high. This is a bullish breaker. What is that? The low here makes the high, and then a lower low. So this move up, you were focusing on the highest up close candle. Extend that range out. So as it's digging into this here, this is a return into that bullish breaker. Here's how you classify retail support resistance as the real levels to be trusting. If that high has a low prior to it and a lower low after it, after this high forms, then it comes back down to it, then yes, you can trust it as resistance broken turn support. The narrative behind why it should be that way is what makes my breaker the breaker. It broke anyone that was holding stops below here. It went lower than that and then ripped through this short-term high. This in itself is a shift in market structure. Same event is occurring with this short-term high here when that candle passes through it, is occurring with this high, with this movement right there. The logic is that we've done damage with this candle being a high here. It took out and broke. It broke the backs of anyone trying to go long on that low. When it ripped up higher like this, then it went down one more time to knock them out. There's liquidity taken here and absorbed. What kind? Sell side. Who would want to take out sell side? Individuals that want to go long. Smart money. Buying those sell stops up. They're being counterparty to it. Then using the fair value gap as it drops into here. And then one more time here. And it rips through this short-term high here. And it comes right back down into that high. But more specifically, it's a bullish breaker and old high, yes. And there's a fair value gap right there. You have three things qualifying that level.